Hi, welcome to episode 3 of the Engelbert podcast. I am Gareth, co-founder of Engelbert.
And I'm Wayne, also co-founder of Engelbert.
Magic.
What have
Okay,
we
so go on, Wayne.
what have we got today, Gareth? We've said we're going to cover a separate topic each week. We've done the intro to the financial promotions regime for crypto assets. And I think we're starting to get into a little bit more detail on some of the specifics, right?
I think that's fair. We we might want to make these very, very narrow topics, otherwise we might run out of things after week 4. But why don't we do due diligence today?
And we mean due diligence of assets by that, don't we? By the specific crypto asset tokens.
Yes. And for anyone who's listening, you can probably tell these definitely aren't scripted or very hastily prepared. So, on that, yes, due diligence of crypto assets. First, probably we'll start off with a bit of the why. Why do we do it?
So specifically, as Engelbert, we're approving promotions and communications for crypto asset projects, exchanges, whatever that might be. And from our perspective, if we're going to be putting our name on something that talks about a crypto asset, then we need to know what that crypto asset is and what it's doing, what the risks are, and what it means for customers and investors in those crypto assets.
Yeah, absolutely. And there's also just that bit of, the regulator doesn't want investors, particularly retail investors, to be exposed to assets that are just not suitable for them or frankly are illegal or, don't have the proper protections in place. So this is about us making sure we're not giving, I suppose, credibility to assets that shouldn't otherwise be given any credibility in the marketplace. And there's probably a few of those that you could think of off the top of your head. So I don't anticipate that there's too much appetite for us to go into like really granular detail of what this process is, but I think it probably is instructive to understand the things that we're looking for. So why don't you, Wayne, start off at the high level with the various sort of topics that we're looking at in diligence terms?
Yeah, so there's a few elements to this, right? So there's the project out of which the asset is born. So tokens often you look at layer one stuff, like you look at your obvious things like blockchain and Ethereum, which are just they're crypto assets, um, and they're often used, I guess, for payments. They're used for, as is claimed, a store of value. They can be used for speculation, but that's their purpose primarily. But what we find is that the vast majority of tokens that we're looking at and that communications in respect of actually are governance or utility. So they sit behind or within a specific project. And there's some really interesting projects out there, and it's quite interesting that we get to delve into those a little bit through our asset diligence. And then we look, I guess, at the token's behavior. It's things like its economics. So what's the market cap? How much is free float? What's the price volatility looking like? What's the age of the token? Some of those things that you're probably more familiar with from the equity world, where you will, on the one hand, look at the company that the equity is invested in and what's that business doing, and then on the other side, you look at more of the financial analysis of the asset.
Yeah, I think that's right. Um, so I suppose it's important to note that it's not just our job to do this, right? So, most of the time, if we are working with someone, then either they're a token issuer themselves, in which case it's incumbent on them to obviously know what they're doing, what they've created, what they're selling, and to be able to communicate that with us. But also, if we're working with an exchange, for instance, then of course they will have their own diligence processes that go into listing those tokens in the first place. And um, often that will be a multi-stage process that probably looks at things like legal risk, and it looks at compliance risk, and it looks at security risk to understand sort of the features of what that token is, what it does, how it works, and whether it would be appropriate to list it on the exchange that is in question. And importantly, we, Engelbert, can't rely on that diligence that's being done by the client. because ultimately that sort of put us in a position of relying almost entirely on what we're being told as being, correct and truthful and super detailed. And sometimes that might just not be the case, and it might just not be appropriate for us to rely on that. And so we're going to always have to double check for ourselves the risks of certain tokens. And that's, quite an involved process, right? Because we have to use a lot of different systems to make this work. So, for instance, we will always have our internal checklist of things to look at for each project, and that will inevitably need us to do some scouring of the internet in one form or another. And there are some tools that help us do that. And there are tools available to exchanges and other people that sell tokens to do that diligence, or to help them do that diligence. But I suppose there's a question about the use of tools in this space, right? And how people actually, one, get the information, but then two, what they do with it, which is quite important.
Yeah, it plays to a really key point that from the regulator, which is having, as you say, tools to help you carry out diligence is well and good. I think they quite like to see that if it makes you more efficient and more in depth with your analysis. But it's very critical that you don't rely on that, take it as read, that you don't treat that system or that tool of diligence like you're outsourcing your responsibility to diligence assets. And that is true right across the board on regulated activity, where you hold the responsibility. So in this instance, Engelbert is responsible for carrying out diligence of the assets. We can use tools to do that, but we can't ever say, for example, well, the tool told us it was fine and we believed it. We have to almost diligence the diligence tool to make sure that it's appropriate and that we understand what it's doing and how it's doing it. And yeah, really critical point there is what you do with that information. So it's tempting to receive information from a system, from an external provider, whatever that might be, and to say, there you go, I've done it. But really what you've got to then do is map the results, the outcomes of that diligence and whatever report or whatever you receive to your own business's risk profile, to your own due diligence process. So yeah, as you say, Gareth, we've got our own checklist, we've got our own diligence process. It takes us a good while to work through that, not because we're spending loads and loads of time gathering the information, because tech helps with that process, but because we then have to understand what that information actually means and what we're going to do about it and what the end decision is. And the end decision is ours to make, not an external provider's.
Yeah, exactly. And so let's just assume that someone listening to this is an exchange, or someone who does need to do diligence on a token and doesn't, or hasn't necessarily thought about the process that needs to go into diligence on the action side. So, okay, you've got a report, you've cobbled together some information, and on that report it says, FYI, this is a risk, or that's a risk. And the question then of what you do about that comes into play. And I don't think oftentimes that's very obvious. In traditional financial services, you'll have teams of compliance people who've spent their entire careers looking at risks in some form or another, and then mitigating and putting remedial steps in place. Crypto may be less familiar with that, and so it's probably worth just doing 2 seconds on that piece. And so, at a high level, the point is you've had the risk identified, great, and that identification will likely say, this project has a problem here. You should consider what to do about that. And of course, it will always be fact specific. But the process then of taking that information in is a sort of dance in a way, right, between the compliancy function, the legally function maybe, and then the board or the senior management or intermediate layers of hierarchy, right?
And that's why, certainly in my experience, it's really important to have a process that you can follow consistently, so that when you are diligencing assets, you're doing it in the same way, through the same lenses, with the same risk mapping every time. And it's important to have some kind of scoring or rating mechanism or something, to the extent that you can do. Gets difficult with qualitative information. It's obviously easy with quantitative data, but that you have some kind of mechanism so that firstly, you become more efficient as a business. But secondly, so that when you are going through that hierarchy or through that sign-off process and review process, you're not creating discussion points and debate in respect of every single element of the diligence. You already have your answer. You agreed what the metrics were at the outset, and you run with that consistently. Otherwise, it can become a total nightmare, because it's, well, what did you say last time? Does that map across this time? Probably not, because assets are all so very different and the risks can be so nuanced even within single categories, that it just becomes a debate at the level, at ground level, when the work's being done, and then it gets passed up to the next layer if it needs approval because it's above your risk appetite, and then it becomes yet another debate, and you end up tripping over yourself very, very easily. So you want something that's efficient, but also something that's robust and repeatable.
Yeah, and ultimately you need to find the right level of authority for that decision to ultimately be made. Is this risk in our appetite or not? And at some stage, that will stop either a mid-level management layer who has the authority delegated to it to say, okay, fine, we accept that risk because it's in our wheelhouse and we understand it, or ultimately at the board level, where the board has to make the call about whether that risk is appropriate or not for the business. And so, you might say, okay, well, this is a high risk, but as a business, it's within our appetite because we understand that we're in this high risk area and we've actually mitigated those factors with X, Y, and Z. Resources or procedures that mean we'll always keep that under wraps. And that's really it, right? So it's get to the decision, have the process that says how you got to the decision, and report on it. The key thing is make sure you've got it documented, because ultimately, if you ever get asked the question, why did you get comfortable with that? Why did you ever think it was appropriate? You're ultimately going to have some justification, and not post haste, but documented at the time of thinking about it. That feels like the sort of sensible route through that.
And it's probably worth as well just remembering that the reason why we do the diligence. So we've talked a lot there about a business's risk appetite, which of course you've got to have, and that should be at sort of at the forefront of the process. But the anchor point always should be, what would it mean for a customer or an investor in those tokens? And that's what the regulator's getting at when it talks about things like consumer duty and the varying and debatable degrees to which that applies to this world. It does exist, and it certainly can't be ignored. And I don't think it's necessarily a bad business practice, as we've said before, to think about it from that perspective. But what would that mean for the customer? So you don't just want to get drawn into a position where you're protecting your business by doing due diligence, but you're also looking after the interests of the investors. So, what do we not want to happen? We don't want people to be steamrolling themselves into, I don't know, let's say like an ICO that's not gone through the proper channels and is fundraising through means other than the way it should be doing under local regs, and therefore it's liable to be taken to court. There's litigation involved and all the horrible stuff that comes with that. Or it's a brand new token, it's an early stage token, and it's been ramped and rug pulled. And these are all the kind of things that you're looking at, yes, to protect yourself as a business, but also because you don't want your customers to be harmed, because that reflects pretty badly on you as a business anyway.
Yeah, I think that's fair. And I suppose the key thing in that is it's an imperfect science, this, isn't it? Because you're always just capturing it at a point in time. You only ever know what you know at the point that you do that diligence. And so I suppose the most important critical bit of diligence is that it doesn't just stop at that point, that you have this ongoing monitoring ability to say, okay, well, we noted that this was the risk at this particular point in time. How frequently do we need to review that and see whether it plays out as we expect, see whether the risk changes, and see whether its impact on us as a business and its potential impact on consumers likely also changes as well. And that could take many forms, right? You could just repeat the diligence process over and over again ad infinitum, or more likely, you can look at the particular risk in question and figure out how you keep that in check. And again, always going to be a question of fact, right?
Yeah, it certainly is. And this is the problem that all regulated firms struggle to grapple with a little bit, in terms of carrying out due diligence at the outset, knowing that it takes the length of time it does. It doesn't feel very attractive to keep doing that repeatedly, especially when you're getting into the hundreds of tokens that are being looked at, and it's certainly not very efficient. And that then is where data and tech can come in and help. So, like we said at the start, data and tech is not going to solve your problems on their own. The problem is very much a sort of more of a cerebral one. It's more of a psychological one of how do you deal with all this information and what does it all mean for us and the customers and the business. But the way in which you gather that information and what you do with it, etc., that's where tech can come in and help. And very much that's where it's needed for, as you say, Gareth, for the ongoing monitoring, because you can't do hours and hours of diligence on a token every month, every week. And let's be honest, even if you did, things are so fast paced in this sector that you'd probably be a day behind whatever it is that you're trying to avoid in any case if you did it that way.
Yeah, and I suppose what's interesting about this is of all of the things you do in a sort of regulated sense, I know for most crypto firms that's not going to be an issue, but as the authorized firm that helps communicate, what we have to think about is proportionality a lot. So the structures and the resources and the controls that you put in place are always proportionate to the nature and scale of your activities often. But diligence sort of bucks that rule slightly because you sort of need to do more diligence the less control or structures you have in place to understand the position you're in. And that's where the cost element, the time cost element, money cost element comes into play because the more exposed you are to the risk in real terms, the more you need to be able to stay on top of it. And tools can help. But the problem with tools is, of course, you just get an information overload of here's more things you need to consider, here's more things you need to think about, here's, 20 red flags, 200 yellow flags, and 700 green flags that you have to be aware of about this asset or this list of assets. And that then is incumbent on you to do something about that, whether to review and say, okay, well, it's not relevant, or to include in your risk consideration. And that's just a time thing. You can never get away from the fact that the more information you get, the more you have to do with it. And that can also be quite a challenge, I suppose, for projects because, if they don't have full-time teams of risk analysts and risk experts sitting alongside the compliance teams who will no doubt already be quite busy with the other elements of what they're trying to do as a business, then you end up in a position where you can't actually keep up with the diligence requirements. And it's true of us too, right? We also have to keep on top of our risk obligations and monitor and continue to monitor those things that we say are okay to market. And that's the challenge there is making sure that you get quality data at the right point in time and have the resource to do something about it. And that is as much an operational and logistical challenge as it is about putting the right tech in place to get you the information.
And it's and it's an experience challenge as well, right? Because it takes or it can take a few experiences to work out what data might mean from a risk perspective, or even to understand what the risks might be. So again, another easy trap to fall into is to say, I'm worried about a rug pull. And so you're always looking for rug pulls, and you may do a very good job of avoiding promoting assets in a way that they're exposed to that. But maybe the thing that's actually going to cause you problem is something you hadn't thought of. It's something completely different that's never happened before. And so if you over processize diligence, then you're in danger of creating gaps that you will miss. And it's experience and learning over time that will sort of teach you what to look out for that you weren't expecting, and to read signals, even if you don't know what those signals might result in, but just to get a bit of a sense from the data and from the information you're receiving of the things that you might not have thought of. It's kind of like scenario testing, but making up the scenarios rather than just relying on what's happened in the past and assuming that the worst that could happen is the same thing a second time.
Yeah, yeah. And there's a superb book on that called Black Swan, about literally black swan events in risk spaces, I think by Nassim Taleb, which, is a very good starting point for thinking about how you might structure risk thinking, albeit not applied directly in this context, but certainly helpful. And so, just to sort of signpost where we've been with this discussion so far, the very high level of what we sort of cover as a diligence piece, the practicality of getting information, the how you deal with the actions and the risks that appear, and the ongoing monitoring of those. I suppose the last thing that's worth thinking about or discussing is probably like specific things that in this particular space are difficult um, to assess for, or difficult to or pose particular challenges. So, for example, um, one of the biggest challenges that we probably face when diligencing assets is finding the legal corporate structure that sits behind a lot of projects. And of course, there's partly the fact that a lot of projects purport to be decentralized. And I mean, even to the extent that that's probably not true decentralization, and there'll be, likely some entities somewhere around the world, whether that's a Cayman Foundation, a BVI Foundation, Panamanian structures. Um, there's a real challenge there in getting crypto projects often to own up to uh, who they actually are, like who is the person ultimately responsible for this. Because as far as the regulator is concerned, I think the question is, and I think you'll probably put this better than me, Wayne, is who's making the money? Is somebody actually getting paid to do this activity? And therefore, probably there's somebody there that should be on the hook for whatever this thing is. And obfuscation of that behind legal structures that don't have, easily searchable corporate registers is one thing, but it doesn't. And as someone who then has to try and say, okay, well, we can either get comfortable with this project or not, that has to factor into the thinking. And we've obviously spent a lot of time, haven't we, when thinking about where we source that information from, because no matter where you go too often in the crypto space, CoinMarketCap, CoinGecko, there's loads of information about tokens and how tokens work and how tokens act and what the price is and the volatility and the liquidity. But absolutely sod all off and on. Who's the issuer? Who's actually putting this token out in the world?
So the difficulty with this decentralization concept is it doesn't really work very well for the regulator, and it doesn't really work very well for the customers. And ultimately, what the regulator will be thinking, and the way we've got to think when we're looking at diligence and we're looking at ownership structures, we're looking at who's controlling projects, who's controlling issuers, is it's like pulling on a thread. So eventually, you're going to pull on the thread and find what's at the end of it. If you're a customer, you can follow that trail through. And if something has gone bad somewhere, then ultimately someone has caused the customer to be involved in that project or that token, that's given them the poor outcomes or that's delivered the harm. Now, it doesn't always have to be because of the ownership of the asset or who's built it, etc. It could be someone within that. Of course, it could be the financial promotions approver who let a promoting firm say things that were misleading or untrue, and therefore they're the ones at fault. But the point is, if something bad happens, if there is a poor outcome somewhere, then you follow the trail and you find the source of that poor outcome, whatever that might be, and that's who the regulator and understandably who the customer is going to be looking for, and that's what we're trying to find. Of course, there will be external influences that have nothing to do with the project, nothing to do with the people that designed it, nothing to do with coin offerings, nothing to do with the exchanges that enable trading. nothing to do with the financial promotions approvers, but we're not here to remove all risk, because if we remove all risk, then we're going to remove everything, right? The potential good outcomes too. You can never do that. You've just got to do as much as you reasonably can. Again, to the proportionality point that Gareth talked about, what's reasonable? What steps did I take to make sure that I did enough diligence and I knew enough about the project or the token or whatever that might be, that I could be comfortable saying, yes, this is okay, and we think we're happy to go ahead and approve that.
Yeah, exactly. And so we've got who is the issuer question trying to be answered, and that's fundamental, right? Because ultimately, the person who is the issuer is probably the person that ultimately the book stops with, and so as part of that, you've also got to know who the team is behind the issuer, because obviously, reputation of individuals is likely to tell you a lot about the validity or otherwise as a project. And again, projects take different approaches. Some like to be very upfront and honest about who's involved, but others tend to not be. Hilariously, of course, you've got that slight dichotomy where with Bitcoin, you actually don't know who originally launched the project, who originally issued the token, but yet that is the gold standard of the tokens in this space in a way. And so it's not all, as you can see in that context, having that information and knowing that information isn't the be all and end all, but it does give you a signal of the kind of risks you're playing with in one form or another. And of course, you can mitigate that by saying, well, actually, over the course of its lifetime, this asset has been very stable and solid, and there's been scams actually by the project issuers themselves, because actually it was just genuinely released and out there, and people could use it as they sort of chose. But it is something that you would bring into your wheelhouse to say, okay, we know the team behind this, or we don't, and as a result of that, we have to bear in mind that these are the options that could come of it. So you've got issuing entity, you've got team behind the project. I suppose in terms of other factors you might look at, hacks, exploits, governance exploits. So are there known or potential exploitable features of the code base? And so, of course, exchanges will often have people who will do that analysis of the code itself, smart contract audits, to see whether that code is solid or not. And again, to your point, Wayne, they can never take away all risk that something might be used nefariously. It is a feature of the fact that these are code-based products rather than paper-based products. And equally, if the governance structure itself can be manipulated by human manipulation, and again, that's always going to be a factor here. People can be manipulated, can be exploited to do certain things, maybe against their own interests, or even just someone hasn't thought through the implications of how someone might amass enough voting power to be able to change the structure and dynamics of that thing that's happening, or even just gain enough control of it to drain the treasury or the wallet of all of the funds in there. So all of those things are relevant and at play and need to be factored into your ultimate risk appetite for listing, selling, promoting, allowing retail investors to access a particular token.
And that sort of brings back nicely, right, to one of the earlier points, which is given all of those things that we're looking for and all of that information that we may or may not get as a result, and bearing in mind that this is not it's not a sort of binary outcome. It's not, I know the owners, therefore it's fine. I don't know them, therefore it isn't. You've got to work out what you do with that information. So if you've got a very small new project, you don't know what the ownership is, you don't know who's pulled this thing together, it's got some super volatile pricing on it. The market cap looks enormous, but actually what's been traded in volumes every day is absolutely tiny. That combination of things together gives you the risk outcome, which is how you end up in a place where, as you've rightly said there, with Bitcoin, you don't know who's come up with this thing in the first place. However, the other pieces of information that we have available to us, like price movement, market cap, its adoption levels, its history, its track record, the sort of lack of problems in the in the code, and etc., all comes together to form an end result, which is this risk is acceptable. So it's not a tick box exercise. It's not a report PDF sat in a folder somewhere. It's the outcome of all that thinking and that analysis that arrives at the end decision.
Yeah. And ultimately, I think that's probably a great place to end, right? We've covered what to look for in diligence, what particular issues to look at, how to do the ongoing monitoring piece. There's a lot of factors to bear in mind here, and of course, we're always available to answer questions that people might have if you want to reach out. Obviously, we're on YouTube, so you can probably get us in the comments down below, or otherwise at our public email address. So yeah, do reach out if you've got questions. If you need tips for providers that you might use on carrying out diligence, again, more than happy to answer those questions. Any final thoughts, Wayne, before we wrap up for today?
I think we've done it justice, Gareth, and I think the point we're making is it's not easy, but if it was easy, everyone would be doing this, and they aren't all doing this. It is achievable, and it can be made into a fairly efficient process, but it's certainly not something that you just pass off to someone else to do and sort of wipe your hands of the problem. It needs some thinking, but yeah, it's a constantly evolving issue, and it's not unique to crypto. We know that due diligence is a problem in every aspect of regulated financial services. Everyone's grappling with the same problems. Sometimes there is a little bit of comfort knowing it's not just you that's got that issue.
Superb. And that is a wrap.
Until next week.
See you next week.
Thank you, Gareth.
No, thank you.